Energy shocks, higher yields, and an AI-fueled equity boom are pulling portfolios in different directions today. This is vTalkInsight, Allocator's lens daily for June 4th, 2026. Let's start with equities, where AI optimism and record earnings are running straight into macro and valuation headwinds. In equities, the central tension is clear. An AI-driven earnings surge is powering indices, even as macro risks pile up. U.S. earnings have jumped sharply year on year, with technology and semiconductor names leading and operating margins projected to push toward historic highs, giving fundamental backing to recent price gains. The AI infrastructure build-out is enormous. Capital spending on data centers is now measured in the hundreds of billions, and some estimates suggest it has roughly tripled in just 2 years. Semiconductor stocks have ridden that wave, with the chip index posting outsized gains as companies like Broadcom report triple-digit AI revenue growth and renew long-term partnerships with hyperscalers, reinforcing visibility around future demand. On top of that, a new wave of megatech IPOs is testing the depth of equity risk appetite. SpaceX is coming with what would be the largest U.S. listing on record, seeking a valuation well over $1 trillion on relatively modest revenues, a small free float, heavy retail participation, and no formal anchor investors, which together could create sharp, technically driven price swings and meaningful index effects. At the same time, some of the strongest price action is in the frothiest parts of the market. Indices of unprofitable tech have surged from their March lows. High beta momentum baskets are up over 40% in just a few weeks, and technical indicators for the tech sector are at levels that in past cycles preceded notable pullbacks. Upcoming AI-related IPOs at extremely high revenue multiples, coupled with questions about sustainable business models, add another layer of late-cycle feel. Macro and policy risks are now pressing harder on that equity story. The OECD is flagging slower global growth alongside stickier inflation. Middle East tensions are driving oil toward triple digits, and U.S. data strength is lifting bond yields, all of which tighten financial conditions and compress prospective equity risk premia. There are signs of internal rotation, too, with defensive sectors like utilities, energy, and staples at times leading despite record index levels, while single-stock volatility stays high even as index volatility remains relatively subdued around the mid-teens, helped by unusually low stock correlation. For allocators, that leaves equities caught between powerful AI and consumer earnings momentum on one side and rising rates, energy costs, tariffs, and a heavy IPO calendar on the other, making the durability of current margin and growth assumptions a key focus before we turn to rates. In rates, the story is that stronger growth data and energy-linked inflation risks are reinforcing a higher-for-longer backdrop. Recent U.S. releases for manufacturing, services, factory orders, and job openings all point to resilient activity in a still tight labor market, with wage growth for job stayers and movers staying elevated, even if the pace is moderating a little at the margin. That resilience is feeding speculation that the Federal Reserve may not just delay cuts, but could even have to hike again if inflation reaccelerates. Some commentary points to policy rates needing to stay around, or even above, current levels to cool the economy, while long-term yields have moved higher, with 10-year borrowing costs seen anchored in a 4 to 4.5% range and 30-year yields pushing toward 5%. Large fiscal deficits add another layer of concern. There is growing discussion that persistent borrowing could eventually spark a bond market backlash, similar to episodes seen in other countries, forcing an abrupt repricing of the long end and potentially threatening the very equity rally it has helped finance. Even so, the bond bear market is not a straight line because higher yields continue to attract buyers at key levels, producing sharp countertrend rallies and keeping rate volatility elevated. For multi-asset portfolios, the uncomfortable piece is correlation. Equities and bonds are moving more in tandem, driven by oil and inflation dynamics, which undermines traditional 60-40 diversification, just as cash yields near 4% offer a more compelling low-risk alternative than in the past decade. Against the OECD's warning of slower growth but higher future inflation, and with Middle East energy risks unresolved, the key watch points now are incoming inflation prints, labor data, fiscal headlines, and long-duration demand, all of which will feed directly into the next phase of both rates and equity repricing. Turning to credit, headline metrics still look relatively calm, especially in public markets. High-quality borrowers are accessing capital on reasonable terms, and AI and energy-related projects continue to secure funding. With much of the AI data center build financed by large, investment-grade counterparties and leverage often contained at the project level. Beneath that surface, however, the stress is showing up in liquidity rather than immediate defaults. A series of semi-liquid private credit and private equity vehicles have installed or tightened redemption gates, sometimes capping withdrawals at around 5% per quarter after seeing requests closer to 10% of assets, particularly from individual investors in Asia-Pacific and Australia. Managers argue these steps are designed to protect remaining investors and preserve investment capacity, and note that such evergreen funds represent only a small slice of the overall private credit universe. Underlying performance is still reported as solid, with some platforms growing assets by more than 20% year-on-year, but market focus has shifted toward credit quality, covenants, and a tight link between private credit and equity, given loans often sit at about 40% loan-to-value. At the same time, there is unease about how much new issuance credit markets can absorb, especially in lower-rated segments, if current conditions stretch into 2026. Private equity valuations have already adjusted to higher rates, with more use of secondary transactions and refinancings to mend legacy capital structures. Yet if inflation or growth were to disappoint sharply from here, today's tight spreads and growing redemption pressure could amplify downside moves, making credit spreads, default data, and fund gating decisions important indicators to monitor. In foreign exchange, policy divergence and energy prices are setting the tone. The U.S. dollar remains underpinned by relatively strong growth and higher yields, with models suggesting it is close to fair value, but still biased to stay firm or strengthen modestly, especially when geopolitical risks push investors toward perceived safe havens. The Japanese yen is the focal point. It is trading near 160 per dollar, a level that has clearly captured policymakers' attention and prompted warnings that intervention is on the table. The Bank of Japan is widely expected to raise rates by 0.25 percentage point and is signaling a gradual move away from its ultra-loose stance. But many see currency weakness as rooted in deeper rate and policy gaps, which means one-off intervention may only slow, not reverse, yen depreciation. Elsewhere in Asia, rising oil prices are squeezing energy importers and weighing on currencies more broadly. The Korean won, for example, has lagged despite a strong local equity market, as the terms of trade shock and a policy preference for competitiveness support a weaker currency, while export gains from AI-linked sectors are recycled into the U.S. tech cycle rather than bolstering the won directly. For global portfolios, that makes FX a key transmission channel for energy and rate shocks, and leaves yen moves, Asian importers' currencies, and the path of the dollar central to cross-border return dispersion. Finally, commodities, where energy is once again at the heart of the macro narrative. Crude prices have surged, with Brent edging toward $100 and U.S. benchmarks jumping, as escalating tensions in the Middle East raise the risk of supply disruption and keep a sizable risk premium embedded in the barrel. Reports of attacks on shipping and infrastructure, missile strikes causing operational disruptions around key Gulf facilities, and ongoing uncertainty around ceasefire talks are all feeding concerns about the security of flows through choke points like the Strait of Hormuz. Global oil inventories are drawing down rapidly. U.S. diesel stocks are at their lowest in decades, and analysts warn that if shipping lanes are not normalized soon, shortages in refined products such as jet fuel and diesel could trigger further sharp price spikes into the summer. That has broad macro consequences. Higher oil and gas prices push up headline inflation, complicate central bank efforts to declare victory, and, as we discussed, strengthen the link between energy, bond yields, and equity valuations. They also widen the gap between energy exporters, which can better absorb the shock, and importers in Asia and Europe, whose weaker currencies and larger trade deficits amplify the policy challenge. Overlaying the geopolitical story is a structural one: the power needs of AI. Surging electricity demand from data centers is driving a wave of investment into transmission and distribution, with some operators building on-site generation tied to natural gas pipelines to bypass grid bottlenecks, while utilities face political pressure over rate hikes and rising scrutiny around grid resilience, including cyber threats. For allocators, That leaves the commodity and energy complex not just as an inflation hedge, but as a central driver of cross-asset risk, linking Middle East developments, power infrastructure, and the trajectory of both rates and FX. Stepping back across assets, the picture is one of powerful AI and earnings tailwinds colliding with higher energy costs, higher for longer rates, and emerging liquidity strains. Equities are buoyed by record profits, semiconductor strength, and a packed IPO pipeline, yet they are increasingly sensitive to long yields, oil prices, and any wobble in the AI narrative. Bonds are repricing to resilient growth and sticky inflation, with fiscal deficits and bond market revolt risk hanging over the long end, while cash yields offer a credible competing home for capital. Credit still looks resilient on the surface, but is quietly testing the plumbing of semi-liquid funds, and FX is channeling policy and energy shocks through a firm dollar, a fragile yen, and stressed Asian importers. In commodities, tight inventories and Middle East risks keep oil and gas at the center of the inflation and stagflation debate. Over the coming weeks, allocators may want to watch how labor and inflation data interact with oil, how private credit funds manage redemptions, how mega IPOs trade after listing, and whether yen policy or Middle East headlines become the next volatility catalyst. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.